artificial intelligence. And so just to look at the operating expense, the restructuring here and the impact, the company says here that if they excluded that restructuring charge, the diluted EPS would have been $1.24 higher for the fourth quarter. And that's part of this, the comparison here. There's a lot more on Outlook, but I'll be back to you in a minute with that as well, Scott.
Let me just ask you a question, too, and forgive me for doing this on the fly. I know it's difficult as you're going through everything. It looks like the guidance on revenue is pretty decent, too. $26 to $28.5 billion for the first quarter. Street was at 27. Yep. Right. You know, the high end is obviously higher than their number was.
So yes, that's right. So they're guiding for revenue in the first quarter between 26 and 28.5 billion. That's important because remember that Snap just guided to lower first quarter revenue than analysts had been expecting. They also are in the CFO Outlook commentary here talking about how the expenses will be lower than what they had previously said. Now they're saying the full year 2023 total expenses will be in the range of 89 to 95 billion, lowered from the prior outlook of 94 to $100 billion. So really lowering the expenses there. And they're saying that they now expect to record an estimated $1 billion in restructuring charges in 2023 related to consolidating the office facilities footprint. They also lower the capital expenditures range to between 30 and 33 billion, lowered from the prior estimates of 34 to 37 billion. So while their revenue is continuing to be in the range that analysts had hoping for, they're also bringing down those expenses. And we see that is resulting in the stock popping over 13%, Scott.
Oh, I'm glad you brought that to us as well. Come back on with us the moment you have anything else. Julia, thank you. Let's bring in Meta shareholder now, Stephanie Link. She is Hightower's chief investment strategist. What's your reaction here?
Yeah, I mean, it was pretty good. I was really nervous because the stock rallied 27% year to date, and it's up 68% from the November 3rd lows. That being said, it's still down 50% from a year ago, Scott. So it still has a ways to go to catch up, and the numbers are good. You guys talked about the revenue. Revenue came basically in line on the high side of guide. So the guide was 30 to 32.5 billion. They came in at 32.17, so pretty close. DAU certainly happy. I kind of expected that, but it all has to do with expenses on this. At this company, right? We know that they are too high. They have been too high forever. So the fact is that they're lowering total expenses pretty substantially. That's actually more than I thought, to 89 to 95 billion from 94 to 100. That's pretty impressive. And of course, CapEx too. By the way, I think I saw that they also are announcing a $40 billion buyback program. So that's also pretty positive.
I mean, yes, you did see that, and we're just learning of that too. $40 billion buyback, but I feel like you kind of got a little bit of everything that you wanted, right? DAUs better than expected, revenue drop not as bad as feared, and then the spending seems to be coming down as well to the degree that shareholders have been voicing their concerns about, and that's showing up to a 15% gain. I'm just going to round up here in this overtime move in the stock, Steph.
Yeah, I mean, look, there's a lot that they can do on the expense side of things. We know that they announced a 13% headcount reduction, or 11,000 people. They did that back in November. But Scott, for the last 4 quarters, they hired 19,000 people. So they have more that they can cut across the spectrum, really, right? OPEX and CapEx. And at the same time, looks like revenues are hanging in there. And their flagship business is seeing DAU growth. I really do want to see and look at the Reels numbers, because we have been getting all kinds of signs that ad loads were running better than expected, something to the tune of 14% due to better engagement than TikTok was seeing.
All right. Instant reaction, Steph. Thank you so much. I appreciate that. That's Stephanie Link, of course, Hightower. Wrap it up for me, because I got Gunlock waiting in the wings, and we want to get to that.
I'll make this very simple. You heard from Evan Spiegel at Snap last night, used the term extremely challenging. The reason it's extremely challenging is because when people are pulling back on advertising, they don't pull back completely. They pull back to the platforms they know they can rely on. They stop experimenting. And so I actually think the Alphabets and the Metas of the world benefit from an environment where people are looking at, well, throw out the 3rd, 4th, 5th, and 6th best option. Let's just go with what we know works. And that might have played into some of the strength that we saw out of Facebook's platforms tonight.
See what Alphabet says tomorrow, along with Apple and Amazon. It's going to be big yet again, Josh. Thank you. That is Josh Brown with us. Let's get to our Twitter question of the day now. We want to know, will there be a rate cut this year? You can head to